In today's video, we will review consumer inflation, producer inflation, personal consumption index, along with GDP for fourth quarter, and what Atlanta Fed is telling us what we should expect in the first quarter of 2025. My name is Anna Eckstein, Coldwell Banker Realty. Let's start. All right. So let's take a look. First article I would like to share with you. Consumer confidence is where the economy is headed, hit 12-year low. One thing that we do have a certainty in today's economy is actually uncertainty. So let's take a look what happens as for the last meeting with the Fed in terms of the rates cutting and the current expectation of where we'll be heading for the 2025 in terms of the rates. So the last meeting that happened was March 19, and the Fed decided not to cut the rates. The Jerome Powell indicated, who is the head of the Federal Reserve, he indicated that they still kind of anticipated maybe 2 rate cuts, but it's just so much. It's kind of watching the policy, how the tariffs obviously will be affecting the economy moving forward. Tariffs is inflationary, obviously. And so there's a lot of uncertainties in terms of where we going. There's definitely stagflation in the horizon. I've been called for stagflation for quite some time. And, as history can tell, any stagflation can lead into the recession. It's when the economy is so weak, but the pricings continue go up. And unfortunately, this is like the worst case scenario for Fed to have a stagflation, because they're tied. The hands are tied. There's nothing what they can do. They cannot lower the rates because the inflation is continue to demolish the economy. And it's unfortunately, just situation is not good. I mean, you guys, for everyday American, it's really hard to go and see those prices, and I don't see them come down. I heard on the news that the eggs was coming down. I went to Publix and I see the same eggs, three rolled eggs over $10. And I don't see them going down. But anyway, if you guys know where the eggs are going down, let me know, please. So this is basically where the history with the fund rates going down. We were at 5.5%. They lowered by 50 basis points on September 18. On November 7, we lower another 25 basis points, and December 18, we got the federal fund rate to 4.5%. So the Fed lower for the last year by 100 basis points, federal fund rate. And for the past 2 meetings, we sit on hold and watching basically the data. So this is the chart. It's updated chart that was released at the last meeting for the Federal Reserve. And what really difference now, what the Federal Reserve is actually expecting. So this is the December projection, and this is numbers would be a current March projections, what they actually change. So they think in GDP for 2025 will be weaker than December projection. Unemployment will be a little bit higher to 4.4%. There's not much of the difference. They're still considering unemployment, obviously, to historical levels, relatively low. And I will share with you later the chart that can indicate that. The PCE inflation, now they projecting that will be higher. So remember, every time when the Federal Reserve talking about the inflation, there's dual mandate with Federal Reserve is unemployment and to bring inflation to the level, and the level for the Federal Reserve is 2%. Now, if they can bring that to that level, God willing, but we'll see. The the PCE inflation, they considering now again that will be higher. That's why they're not running, and cutting the rates as we speak, with so much uncertainty in the economy. The core PCE also expectation for the 2025 would be higher than previously expected. The federal fund rate is expectation didn't really change from December expectation to the March expectation is for the 2025 federal fund rate is 3.9%, which means that there's two cuts expecting by 25 basis points in 2025. Now, if the economy goes really bad, emergency happens, meetings and things like that, of course, they can bring this rate way down than what they expecting right now. This is just expectation based on the last meeting. Now, moving forward, I always share with you some historical data for the reference and also the 10-year Treasury. Now, why is it important to understand where a 10-year Treasury? Because that's where the long-term debt is going in. The rates for the long-term debt is actually going in after the 10-year Treasury. It's very important to understand where a 10-year Treasury is because that's affecting our mortgage rates and any long-term debts, right? So this is as of March 27, was trading at, the Treasury yield was at 4.37. And for the highest for the past, so this chart is 12 months. So you can see in April 25th, the highest for this year, for the past 12 months was on April 25th, was 4.7. That was the highest. The lowest, it's right before the Fed started dropping the rates, was 3.62 on September 16. And we right now trading, you will see on another chart, I think it's around 4.2 something as of last Friday. So historically, where the highest and the lowest yield, the 10-year yield was, and the highest was, can you guys believe, 15.82 was in July 1981. And I will share with you the mortgage rates shortly. And the lowest was actually under 1%, 0.65 on April 20th, 2020. This is right before the COVID. Now, how the mortgage rates arrive, like if everybody says, well, where's the, if the yield trading at 4.29 on Friday, why our mortgage rates is almost 7%? Well, that's the spread. That's what investors charge between the federal fund rate and what the mortgage rates actually are. That difference is called the spread. And that's what investors charge to compensate for lending the money. So, and you can see historically, just pull it up, kind of some dates, you can see the spread historically was pre-2008 crisis was 1.5%. Post-2008 to 2020 was between 1.75% to 2% on average. And during the COVID, between 1.4 to 1.6. And at some point when the inflation started cranking up, it was around 3% between 2023 and 2024. So where we at right now was calculating actually based on the 30 MBA 30 mortgage, which was as of March 21st was 6.72%. So roughly the spread is about 2.42%. That's right now currently where we at. So we're still above the norm. And what that means, why the spread is lower or higher is depends on the risk on the market. For the if there's more risk, like let's say there's more inflationary fear or other risk involved, that spread you will see higher compare when you don't have as much risk. The risk always there in the mortgages, right? But that's kind of where we at. So the highest mortgage rate on MBA 30-year, and what that is, conforming loans balances 766,550 or less. The highest we had was April 26, 2024. We were actually at 7.29%. The lowest we were right before the Fed started dropping the rate was the 6.09, and and this is historically, actually. So the historically is in October 8, 1981. Can you guys believe this? The mortgage rates were 18.63%. And the lowest we had, lucky the ones who refinanced or purchased the house, December 23rd, 2020, 2.66%. That's amazing. So anyway, I just wanted to share with you. The moving forward for the inflation. So inflation expectation for the federal government is 2%. So where we at today, and on the left, you will see the 12 years inflation. On the right, you will see historic, some of the points that I thought would be interesting to share, because it's one thing to talking about where we at today, but history, I always like to compare things, you know? So where we at today is 2.8%. This is inflation for a February reading. We always go the 30 days. This is actually ease from 3% that was in January, and it's below forecast. Forecast was 2.9%. So today for February is 2.8%. Now, historically, if you look in, it's quite interesting data, because we were in the 20s. We were at over 23%, almost 24% inflation. It's amazing. In the 40s, 1947, 19%. In the 80s, Paul Walker era, we were at 12.3% and the double top of the inflation, and 14.8%. So the highest where we've been since our inflation, we were in June 2022, we were at 9.1%. And the April, before the whole inflation starts, right, we were at 0.3%. Now, a lot of people say, well, if the inflation is going down, why the prices still remain high? So we not in this inflation. This inflation, it's when you're in 20s, when you have minus 0.15 0.8%. So inflation still here, just is not as high as 9.1%. So the price is still going up on annualized basis, the 2.8% for the February. So the inflation is still 2.8%. So the price is still going up. So when we will see minus 2.8, that's called disinflation. So the core inflation. Now, why is it important to understand what is the core inflation? So the core inflation is when you exclude volatile items such as food and energy. So when you exclude that, so the target is still 2%. When you exclude that, that's what you get, core inflation. So when we exclude that, today, as of February data, we at 3.1%. Now, to share with you the inflation where been traveled, the core inflation double top in the 70s and 80s. You can see as much as 11.7%. In 80s, 13.6%. That's a core inflation. It's a consumer price inflation. And you can see some of I was just thinking about the GFC crisis, which it was horrific time. I was just got my license, and I got my license in 2005. So it was a very scary time. I hope we will never relive that again. But it's interesting because we didn't had much inflation. And you can see the core inflation in 2009 was like 1.5%. So it was really well, obviously it had nothing to do with inflation, it had to do with mortgage fraud. But anyway, so the highest core inflation in 2022 we had was 6.6%. So this is, if you like, pause. I'm not going to go break down this page, but if you like to pause and take a look, this is the data of breakdown based on food, energy, the vehicles, things like that, where the inflation is adding up. You can see transportation. We actually go in disinflation on that in February, minus 0.8%. The shelter's still there, 0.3%. So, and you can see the shelter 4.2 on the 12 months ending February 2025. So anyway, just please pause and look through. All right. Producer price. Now, why are we covering producer price inflation? Why is it important? Because if it's cost more to producer to produce or pay more in the tariffs or whatever, do you think that they would just swallow the cost and say, well, we're not going to charge it to American people, we just will pay it? Well, if you think like that, that's all what I wanted to say. But it's important to understand and take a look to see where we at on producer price inflation. And that's still going on. In February, we had 3.2% inflation on producer price. And you can see historically that in the 50s, we had 13.24%. In the 70s, the producer inflation was over 19%. In the 80s, over 14%. In 2009, actually, we were in disinflation on the producer inflation, and we were minus 6.86%. In 2020, we also were in disinflation, and the highest inflation on the producer index were in March 2022 was 11.7%. So core, that's again excluding volatile items, and we are today at 3.4% on consumer price inflation year over year, and the highest we were 9.7% in 2022. And you can see before this whole COVID started was 0.3% in June 2020. All right, and let's see. So this is oh, I went a little bit too far. Okay, so the core produce, so PCE. So PCE is a personal consumption index. And we are, and this is actually a preferred gauge for the Fed to track. They're all important, but this is, the Fed is really paying attention to this particular index. So for them, it's quite important to understand. Again, target is 2%, and we are at 2.5% on February data. Now, the highest we were in a double top for the 70s and 80s, over 11%. The highest we were in June 2022 was 7.24%. So you can see the inflation is definitely going down, just not as quickly and not as transitory. It was interesting because they asked Pavel on a conference that he had back in a March meeting. And they asked him, I say, so what he thinks about the inflation that can caused by tariffs. And he said, well, the inflation can be caused by tariffs, but it will be transitory. So then the reporter says, so we're going back to transitory, right? So anyway, I thought that was quite interesting about the transitory. But anyway, let's go back to retail sales. So the consumer still spending. That's interesting. The consumer is resilient so far, but you can see that the retail sales in February up 3.4%. This is some of historical data that you can see there was minus 19.9% in 2020. I mean, obviously everybody was totally COVID indoor. And don't know if the world will be tomorrow, but in April was up as 52.5%. I just thought that was interesting to share. So the personal income and personal spending. So the personal income rose by 0.8%, and the spending is increased by 0.4%. 6.4% in the month of February. Non-farm payroll. So remember I told you in the beginning that the dual mandate for the Fed is the job stability and inflation. So the obviously federal government, the Fed is very pay close attention to the job, and we still produce 151,000 jobs in the month of February. This is kind of the highest in February 2022. You see it's 869,000. And just so you know, when you see these charts, there's revision, right? So, but I always update my charts. So wherever the numbers you see, that's already revised numbers. So the lowest we had was October 2024 was 44,000 jobs. So unemployment rate, and this is something that I wanted to share. So unemployment rate just a little bit went up from 4% to 4.1%. Obviously, a lot of those layoffs, I think they were like more in March. So I don't think this data is really showing because everybody was watching the unemployment, like what happened. And this is data again for February. So the next report that I'm going to do, that will be reflecting the March data, but I will do in April once we have, once the data start coming in. So like in March, it's coming data for February. Now I'm recording this as for the, at the end of the March. For the February data, I will be recorded in April, at the end of the April, so I can collect all the data for the month of March. So anyway, the highest, it's interesting. So the highest unemployment, obviously, we had when we had a COVID, April 20th was 14.9%. But just to give you kind of the concept, the 4% unemployment rate is historically very low. You can see in 2003 was 6.3%, in 2009 was 10%, in the 90s was 7.7%, over 10%, 1982. So if you look at the chart and you pause, it's, it's quite impressive to have the unemployment rate in, well, who knows for how long we will have this, but, at least for what we have right now, right? So this is just a breakdown. You can pause and take a look, but we added government jobs 11,000. The February for the non-private payroll, we had 151,000 and just 10,000 jobs for the manufacturing. So the average hourly earnings, that is up 4% for the month of February, and you can pause, take a look at historic data, what we have as well. So GDP growth is, so this is for the fourth quarter, all right? And I will share with you shortly what expectation would be for the first quarter, but we don't have the numbers yet. So 2.4%, that's the final GDP growth for the fourth quarter of 2024. So you can see we're still there. This is some interesting chart that you can take a look. In the 50s, we were I just picked some of those highest and some of those lows. We can see in the 1958, we was like minus 10%, minus 28.1% in second quarter of the 2020, but then we quickly recover. It's just some crazy numbers if you take a look. So this is Atlanta Fed. They have some models that they're running the projection for the GDP, and what they project in the first quarter of 2025 actually going in negative. The next update would be on April 1st, so I will share with you the next video. And it's interesting because they're projecting that as of March 28th, we will do negative minus 2.8%. So interesting will be to see. But for every piece of information that I provide to you in a video, you can go to the source and do your own research. And there's more, obviously, details that I'm sharing with you, but I share as much as I can. So GDP sales, final 3.3%, real consumer spending still there at 4%. The PCE Q final and core PCE, so we're still there 2.4% and 2.6%. So that's a last chart that I would like to share with you. I hope you enjoyed this video. I hope you find this video valuable for you and for your family. If you do, please don't forget to subscribe to the channel below. I do run the market report also for Atlanta and many of the Atlanta suburbs. Please take a look at them. I will attach one video at the end of this video. My name Anna Eckstein, Ultimate Luxury Group, Coldwell Banker Realty. Thank you so much for watching. Have a good day.